Welcome back. This is Catherine Morgan-Nance with part 3 of our variance analysis series. We will be talking now about direct labor variances. Perfect Pool manufactures a pool cleaning product, and here we have their direct labor standard for 1 bucket of that particular product. So they expect to spend 1/4 of an hour at a direct labor rate of $12 per hour making the product, and that gives them a total direct labor standard cost of $3 per bucket of the product. Additional information is as follows. During the period, Perfect Pool produced 1,000 buckets of its pool cleaning product, and the direct labor workforce worked a total of 220 hours and were paid a total of $3,080 for that production. Well, this is interesting. You can perhaps anticipate that they will have a favorable efficiency variance because 1/4 of an hour times 1,000 buckets yields standard hours of 250, and they only work 220 hours. But we'll see that in a minute. The question I want you to ponder is that the company experimented using more senior staff and fewer junior staff at this period, and was the experiment successful? Why or why not? Okay, so the rate variance for labor is computed simply by comparing the actual rate per hour with the standard rate per hour and expressing it in terms of direct labor hours worked. So in my Excel spreadsheet, which will help me do the calculations, let's just drop in some numbers. Actual direct labor hours worked they gave us those hours, 220 hours. And we don't have the rate per hour, but we can calculate it for information purposes. The total cost was, $3,080, and we can divide that by the 220 hours and come up with a rate of $14 per labor hour for total cost, again, of $3,080. Now, if we were to take those actual labor hours, 220 hours, at the standard rate of $12 an hour, we would see that we should have only incurred $2,640 worth of cost. Undoubtedly, the variance here between the actual rate of 14 and the standard rate of 12 is due to the fact that we're using more senior staff. So let's compute that variance. 3,080 in actual cost and 2,640 in cost expressed at the actual rate. We have an unfavorable variance of $440. In fact, if we were to shortcut the equation, we could do it as follows. The absolute value of the actual quantity worked, that's actual hours of 220, multiplied by the difference between the actual price paid, $14, and the standard price or rate paid for labor, $12, yields a variance of $440, just like we calculated a moment ago. Okay, so with respect to efficiency variance, that's effectively the same thing as a quantity variance. It's just measuring whether we worked more or less hours than we were allowed to do given the actual quantity of the product produced. And we produced 1,000 buckets, and we were allowed to use 1/4 of an hour per bucket, and so we would have expected to work 250 direct labor hours to produce this particular product. So already, as I mentioned a moment ago, you can see that we are 30 hours favorable with respect to the production of these buckets, and it's probably because we had more experienced staff producing the buckets. The standard rate per hour was $12 per hour, so we can express our total standard cost for the units that we produced, 1,000 buckets produced. The total standard is $3,000. So let's calculate our efficiency variance. And that is calculated by taking the difference between $2,640, that's actual hours worked at the standard rate, and comparing it to standard hours worked at the standard rate of $3,000. We have a total favorable variance of $360, and that could be computed if we simply wanted to take the standard price and multiply it by the difference between the actual hours that we worked and the standard hours that we were allowed to work. So let's go ahead and do that. The standard price was $12 an hour, and we actually worked 220 hours, and we should have worked 250 hours. We were allowed to work 250 hours. Okay, $360 favorable variance in this case. And with direct labor, we can calculate a spending variance. It is the difference between actual cost and standard cost of $3,000. So in total, we have an overall spending variance of $80. That's also the difference between our rate variance and our efficiency variance. And remember, these are going opposite directions, so we will net the two amounts and come up with a overall variance of $80 unfavorable. I hope that makes sense. We should answer the question that I posed at the beginning of this problem. The company experimented using more senior staff and a few junior employees this period. Was the experiment successful? Well, not really. Our overall variance was $80 unfavorable. We had an unfavorable rate variance of $440 due to the fact that the senior employees were paid more. They were paid on average $14 an hour versus our standard of $12 an hour, and the excess costs more than offset the efficiency gains that we realized by having more experienced staff working on the product. So they saved us a little bit of time, but we paid for it in their rate. So overall, it's to our disadvantage to do that by a small amount. I hope that makes sense, and we will come back in the next video to take a look at a rather odd little variance, variable manufacturing overhead variance. See you soon.